We've started a couple of new shows here on the network. As a matter of fact, I know one of them deals with politics, and that's with Stella Adams, and she'll be doing her show on tomorrow and all along those lines. But I've had the pleasure of meeting a gentleman from Duke University, and actually, I don't live that far from that particular prestigious university, and I won't hold it against them since I did have some relatives that graduated from there, and even some friends and acquaintances that worked at that prestigious university, even though I myself am a Marquette graduate and all along those lines. But I won't hold it against Dr. Asher that he did not go to work in the Midwest and all in that space, but he's got some interesting thoughts around investment, and he's brought an interesting guest also from North Carolina as well. But I'll let him introduce himself and see what he's got to say about a number of these investment strategies. Because like I said, I had the pleasure of meeting him at one of our meetings with Pod TV. So I know that he's got some great insight. So I'm gonna actually bounce off and let you talk about what you've got going on and your special guest. And then me and Rick may come on to ask you some of those questions later on as well. But I know you've always got some amazing insights. So I'm looking forward to the discussion.
Well, I'm Salman Azhar. I'm going to be your host for this show. I have invested in over 125 companies. I'm also a professor at Duke University. So I have these two lives that kind of merge together, blend together. I am not from Midwest, but I have a guest today, Sean Plancard. He did his law school. He went to law school at University of Chicago. He lives currently in Charlotte, North Carolina, and he's going to be sharing a lot of insights from the year 2024 and how that went for venture capital industry. So there is Sean. Sean is also the general partner at Azimuth Ventures. Sean, welcome to the show.
Grateful to be here, Salman. Thank you so much.
So, Sean, tell us a little bit about your background. I know you grew up somewhere in Colorado, right? And went to school. Well, why don't you tell us about it?
Yeah, so originally from Boulder, Colorado, and then I went to school at the University of Colorado Boulder, go Buffs. And then my first job actually out of undergrad was as an 8th grade U.S. history teacher. And then following that, I continued an education on a Fulbright scholarship in Madrid, Spain. Returned back to Dallas for a year at an education startup, and then discovered venture capital and investing while at the University of Chicago for law school. And then I met you in Durham, North Carolina in 2018, where you gave me access to my first venture investments at the Duke Angel Network, and you were the executive director there. And now I've had my second exit. The track record is not as robust as yours, Salman. And as you know, we are dear, dear friends.
Yes, definitely a dear friend. Sean was one of the angel investors in Duke Angel Network, which I managed before COVID. And he has had 2 exits from there already, Sean, right?
That's correct.
Do you remember those exits?
I do.
Good. All right, wonderful. You want to tell us a little bit more about those exits?
I think under the terms of the exits, I'll have to keep them confidential, but I can tell you that economically, I was pretty pleased.
Okay, lovely.
Yes.
So the PitchBook recently came out with the 2024 report, and I know you were reading that earlier today, and we talked a little bit about that. So tell us what you learned.
Yeah, I mean, I think as expected, the venture market, like M&A activity and deal making activity across the board, remained substantially below pre-pandemic activities. There were some slight uptick, and I think there is some optimism for some loosening in deal making activity going into 2025. But I think as we still kind of try to look for the resolution of inflation, trying to figure out what the Fed will or will not do with interest rates, a lot of people are still on the sidelines and questioning whether or not the valuations at which they invested before were too high. And it's making harder for early stage startups or new startups to get off the ground, as well as for new funds.
So in case you're not familiar, PitchBook is an organization that is focused typically on private investing. They cover venture capital and private equity spaces. And they came out with their report for 2024. So when it comes to venture capital, there are several types of investments you can make. You can either go very early in a seed stage, often it's called, and then they are coded by letters A, B, C, D, etc. And there's nothing kind of mysterious about the letters, even though they sound mysterious, other than they're just in the order that they are. And typically, Series A would have a certain kind of parameters that you have to meet. And once you have that, then you go to Series B and Series C. So if you are on the investor side of this, the earlier you invest, the higher risk you take, but then the higher possible upside you get as well. So for example, one of my investments IPO'd at 171x, which is 171 times the value that I paid for it. And because I invested early. If I had invested in the same startup in a very late stage, I would have gotten 3 or 4x or 5x. But my risk would be lower because I would be more sure of getting a return as opposed to in an early stage where there are a number of companies that I invested in that completely went bankrupt and didn't get any money back. So typically the way an investor like me works is we look at 10 different investments or 20 different investments or how many ever. And we are prepared to lose in some of those investments because we know that our winners are going to more than make up for losses. So for example, the 171x return made up for losses for 171 companies that I would have invested the same amount, which I didn't. I haven't invested in 171 companies total. So just that particular company paid me back for all my investments. So one of the things that has been really hot recently is the secondary market. In secondary market, rather than investing directly with a company, you buy shares from an existing investors that is typically has been there for 5, 10, or how many ever years, and they want some cash now, and they're willing to sell at a discount. So Sean, tell us a little bit about what you know about the secondary market.
Yeah, well, I think first, just to kind of define our terms, obviously a primary offering just means that you have an investor who is acquiring the securities, generally Delaware C corporation stock, usually at a preferred share in the company. So a primary issuance is when you're acquiring the stock directly to the issuer from the startup. A secondary transaction is almost exactly what it sounds like, but it would be, let's say, Salman, you were invested in a company and I was not yet invested in the company. The secondary transaction itself would be if I wanted to acquire your shares. Now, the question would be, if you have shares that you believe are going to go up, why would you sell those shares?
Why would I?
Yes, why would you? Can you think of any reason, Salman?
I need cash, Sean. I need cash now because
Yes.
I have a huge tax bill to pay. I've been working in this startup for a long time. I have invested in this startup and I need to buy a new home, and my wife would leave me if I don't do that.
Well, goodness gracious. Well, I hope your wife stays with you no matter what home you're in, Salman. I'll certainly stay with you too.
No, my wife would stay with me in a tent if she needs to.
So that's good. Aslina's a wonderful woman. But yeah, so a liquidity need, exactly what you need. When you're saying you need cash, we're talking about a liquidity need. And what we're seeing across the market is that liquidity is a key hurdle for investors of all types. And investors in this marketplace are generally called limited partners. And the structural fact that's leading to that is that the life term of these funds, these pots of money that folks invest in, is generally been 10 years with 2 automatic 1-year extensions. So like fine wine, if you're talking about a vintage 2015 fund or a vintage 2014 fund or a vintage 2013 fund, those vintage funds are at the end of their lifeline and they are contractually obligated by the virtue of their partnership agreements to begin creating and distributing liquidity to their investors. Problem with that is that it's very hard to generate or distribute liquidity of privately held companies. And so they have a cash crunch. Similarly, folks who have gotten very rich or have been participating in the venture capital markets for a long time might have been expecting some of these exits to kind of feed their cash flow needs, particularly in some situations that they might have had lifestyle inflation or partners who may have chosen to leave them if they weren't continuing to inflate those lifestyles. And that would be a situation where maybe you have something that you believe will go to $2, but it's currently at something that you can sell for $1. And if you bought it for 1 cent, even though you would love to get the full appreciation of that $2 value, you would be willing to sell it for less, for $1. And that creates one of the reasons that you might see a secondary transaction.
Wonderful. So fun fact, when I had my first exit, I wanted to move to Atherton, California. Atherton is where all the rich people live. And that was like, where in Silicon Valley, if you're in Silicon Valley, you want an Atherton address. And I said to my wife, we have an exit now. Let's move to Atherton. He said, why would I want to move to Atherton? All my friends are here. So she gave me the license to take all my winnings and invest them back into the market. And they have been really, really rewarding. And it's ultimately just a numbers game. And whatever you say about VC or PE market or have heard about it, they are far superior to whatever you can see in the public markets. That typically the VC markets generally like to give return that is close to 20% annually in terms of IRR. At least that's the target. Whereas like S&P 500 is more like 10% or around 10%.
And Salman, as you know, sometimes you like to drive a little bit more than 10 miles per hour over the speed limit. And my attorney background keeps me at more close to that speed limit. So what I'm saying is
I'm going to keep quiet.
Yeah, but of course, those are the average performance, of those different investment profiles. And of course, you can see outliers on both ends of the spectrum. But yes, generally, investors are rewarded for risk, and depending on their investment timeline, having access to some of these illiquid investments or alternative investments like private equity or venture capital has demonstrated that you can have higher returns. I think go ahead.
Yeah, there's a question.
Oh, no. So I was going to say, it actually kind of raises the question too, if you accept the fact that those averages, are consistent, across the different investment profiles, something that you might wonder is, okay, well, how do I get in? And there's been a push, particularly among some of these folks with liquidity needs, to try and increase access to some of these private investments, because for lots of reasons under the United States securities laws regimes, you need to be what's called an accredited investor in order to have access to these investments. So you have public companies, easy to think of, Apple, NVIDIA, Microsoft is like, the most famous ones. You can buy a public security for the New York Stock Exchange or NASDAQ. These private markets are exactly that. They're private. You can only have access to them if, in the SEC's ultimate wisdom, you have met one of the criteria to be an accredited investor. For a long time, the sort of like economic tests that have been in place to have access to those investments have been at the same level. So with inflation, they have, in real terms, gotten lower. But there is a push out there for people with to be able to have access to these private markets, which would be, if enforced or made open, an opportunity for there to be more access to liquidity for some of these fund managers, their investors, and the founders.
So, Sean, you raise a very important point. So let me just clarify two things. First of all, even though the average return on an S&P 500 has been 10% over the years or close to that, I don't have the exact number. There are years that S&P 500 has lost money, and that there are years that it has gained money. And there are stocks within those that have gained money and lost money on any given day or any given year. VC funds are no different, and companies that you invest in are no different. You can win or lose on any given company. And I was really basically quoting, generally an average. A sad reality, though, is that there are lots of VC funds that never make money and they just disappear. And they're typically, this is not something you just get up one morning and say, oh, I'm just going to start a VC fund myself. You need a lot of knowledge. You need a lot of diligence. You need to have a network that gives you access to deals like this. So this is not something that you can just get up and do. And what Sean has been, what just mentioned is that there is a lot of push in terms of giving more access to more individuals. So not just the high net worth and not just the accredited investor is the term that is used, which is, you can think of it as just a high net worth individual quantified with a certain income level or a certain asset. And there's no reason why this information should not be, or these investments and information should not be more available, other than there are people that are happy to take your money and run away with it, and the government is trying to protect you. And while they're crooks, it's going to happen. Sean?
Well, again, I might hedge in a few of those comments. We'll ask Mark if we can do some of the cutting later. I mean, there are good reasons, why you have these regimes. I think it's hard in law circles, you'll say that sometimes you have bright line rules and you have standards. The question in the chat that Mark asked is, how much do you need to get involved in the VC? And this is one of those examples of a bright line rule. So there's 15 different categories. If you're looking for the formal definition of an accredited investor, you can find it on the SEC website and or the IRS website. You can have it. But for individuals, generally, the two categories in which they fall in is, one, if you have a net worth that is higher than $1 million, exclusive of your primary residence, or two, as an individual, if you have an income of $200,000, or as a couple of $300,000. And I can't remember the precise date when those net worth and income-based tests went into effect, but they haven't changed for quite some time.
Yeah. And if you haven't figured this out already, Sean is an attorney by training, so he has a very strict code of conduct in terms of what is said and what is not said. So,
well, strict code of conduct, values, integrity. I think I just try to be right, or at least tell people not to intentionally mislead people. Not to say that you are Salman, but of course, whether or not you were to draw the line at $2 million or $1 million, these are regulatory acts of discretion that are made by the people that are in power. I think it is, noteworthy to say that they haven't raised the limit in quite some time, or kind of like raised the bar from which you are. So again, in real terms, it has become lower. I see another question in the chat. Are any nonprofits getting into the VC market? I know some are setting up trust funds. Would a VC be a good idea? I'll take the first stab at that question, Salman, and if you have some commentary, you can let me know. So Mark, if you're talking about nonprofits and we're talking about, as traditional like 501c3 charities, that's something that I'm not particularly aware of in terms of like they're investing directly into funds. But certainly there are non-taxable investors, such as university endowments, that have for a very long time been in alternative investment vehicles such as venture capital or private equity. Whether or not they're setting up trust funds as a particular strategy, as a particular vehicle to deposit money, and then have returns from there, I'm not particularly knowledgeable about that, so I can't speak to it directly. And then for the third part of the question, would a VC be a good idea? I think it depends on your risk tolerance. I think, one thing that's nice for non-taxable investors, such as nonprofits or university endowments, is that they don't have to pay capital gains taxes, on the appreciation of the investment. So certainly I guess I might call them tax adjusted returns, might be the phrase that I would use, are higher. And so that they stand to gain much more on a post-tax basis from participating in these than a taxable investor who's not using a tax sheltered strategy to invest, such as investing through a self-directed IRA.
So there are many foundations that invest in VC funds, and universities also do. And typically, these organizations don't pay taxes on their gains. So the VC is taxed differently, or generally investment gains are taxed differently from the way income would be taxed. And you can consult your tax accountant to find out exactly what the difference is. But when there are profits, generally foundations and universities and other organizations like that are involved in charitable causes are exempt from taxes. Unlike individuals, where depending on how much you gain and how much your income is, you would pay a certain percentage in taxes. So a number of them are involved. In fact, almost all university endowments that I know of that are reasonable size invest in VC funds alongside with other investments, real estate, sometimes public markets, sometimes like they keep also cash on hand. Also, trust funds basically are just a way for people to pass on their inheritance to their heirs. And they very often would invest in funds like, a VC fund or public markets or real estate and so on, anything that an individual would invest in.
And just really quickly, I was going to bring Rick in as well, because I know he might have some questions and everything, just to let you and Solomon and Sean know. Part of the reason I asked that question is because I think I told you this when we met, but my mom was the first director of one of the largest trust funds, well, not trust funds, but one of the larger foundations in the United States. If you're familiar with Durham, and I know you are because you both live here, you're familiar with the Golden Leaf Foundation. So my mother was the first president of the Golden Leaf Foundation. So Valeria Lee is now retired, but she was the first president there. And I do know that the money that she earned while in that foundation is part of the reason that she's able to help me in some of my ventures and all along those lines. Because like I said, she's been retired for a number of years. I think they're on the second or third president past her and all along those lines. So oftentimes I'm thinking about foundations because I also work for some arts groups as well. And I have a great deal of respect because I have had to sign some myself, non-disclosure agreements, because I've been in the arts field and everything like that when I've been doing work. So I understand partially what you were saying, but there might be some people that are watching that you have used this term several times that they might not be as familiar with it. So if you could explain maybe a little bit what exit means, because I'm sitting there going like, I'm thinking that this means that he can't actually talk about what money he's made and things along those lines. But there might be people watching that are sitting there going like, I have no idea what an exit is because I was one of those and everything. So if you could maybe explain what an exit strategy is in that sense, because I'm assuming that's what it is. And there are things that you have to sign, because I know even in my own situation, I've been involved, and I know Rick, who I'm here to bring in. By the way, he's a Colorado, and as well as has been involved in, and all along those lines, he lives in California now. But that's the whole notion of things that you can't reveal even in the creative space. So I'm thinking that's what it is with the financial space, but I'm thinking it's similar to an NDA, but I'm not sure. So if you can explain to the listeners that don't know.
Yeah, so I think without giving away, any confidential, it's a great question, Mark. And I think, even just stepping back a level, so many of these terms are terms of art that seem so inaccessible or difficult upon first blush, but really just kind of once you define your terms, they become a lot more accessible. So I really appreciate the question. The first thing is that just to be clear, when we say exit, it's EXIT, not excess, but though you generally hope that you have excess returns. So just make sure that we're using the spelling. And just for sake of simplicity, we'll say that there's 3 types of exit. The second and third one, kind of being different flavors of the same. One that we've mentioned is an initial public offering. So let's say that we start Blanchard Lee startup, and it's a streaming service that goes gangbusters. When we initially raise the money, as we talked about, it's privately invested money. And so there's different restrictions that make it so that you're not allowed to sell it to just anybody. So it's hard to exit or sell it to someone else. One of the most famous and common ones is when you take that early held stock and then eventually it appreciates, it gets divided, and then you issue new stock in an initial public offering on a publicly traded stock exchange through a registration with the Securities and Exchange Commission. So exit type 1 is an IPO.
And John, just to clarify for everyone that whenever you have an exit, what that means is that you are getting a return on your investment at that time. So unlike a dividend stock or a CD or something like that, that gives you like a coupon or like gives you like a certain percentage every month, every quarter, every year, in this case, you get your money back when there is an exit.
Right. And you could also think about it as, you could use an example of, buying a home as a form of an exit. Sometimes when you exit your home, you don't always make money. Of course, we saw that, largely through the 2008, 2009 financial crisis. Not all exits are good ones. They're generally measured using 2 metrics, which is 1, the cash on cash return that you have. So if I bought for 100 and I sold for 200, I made $100. And the second is referred to as the internal rate of return, which is the compounding rate at which the value of your investment grew over time. And those 2 metrics kind of are your scorecard to see like how well you did. I'll definitely get to your question, Rick. I'll just quickly finish that the second type of exit is an acquisition, which just means that a third party acquires the shares of the original company. And that usually comes through a third party, or it can be structured through a management buyout where the internal management team were to acquire the shares of the other investors, usually at what's called a control premium. But Rick, I saw you had a question. I definitely want to make sure.
Yeah, I'm listening to you guys and getting frustrated because for a decade, I've been asking my financial advisors, how do I invest in the future? Like climate change, like longevity, like the industries we know that are going to be huge in 30 years. And they say there's no way to do it now. Most recently, I asked, how do I invest in the rebuilding of Los Angeles? And they said there's really no way. But obviously, like there are companies like the homes to rebuild Los Angeles need to be hardened. which means cement instead of wood framing. But they said, no, there are no publicly traded companies that do 3D, home printing, which is cement. And so it seems like what you guys are talking about is what I want.
I think you're right, Rick. And, assuming, and you don't have to disclose it here, and I see that you're in Los Angeles, so I'm really glad to see, and I hope that you and your family and loved ones are safe, out there.
We've been panicking, but we're okay. Yeah.
Okay. Well, I'll pray for a low heart rate, or sorry, a consistent and non-elevated heart rate for you. But to answer your question, that's exactly what venture capital is investing in the future. And that's exactly what innovation and technology is investing in the future. And while I'm not a registered investment advisor, and while this is not strictly investment advice, what I will definitely share is that venture capital as an industry is something where you're trying to invest in the future, where you're making bets on what you think the future will look like. Love him or hate him, Elon Musk is a very visible futurist, and he saw a world where electric cars would become something that the public, wanted to consume on a mass basis. That was a company that if you were an accredited investor and you had access to the opportunity, you could be investing in the future. The same with SpaceX, the idea that we're going to, commercialize travel or make, travel to space a standard thing. So I won't provide any particular commentary. Perhaps we connect individually after the show, but I can think of a few different, investors that might be raising some funds to try and rebuild Los Angeles, particularly, given how attached people are, to that amazing city.
There's one more thing that freaks me out about VC is if you remember the movie The Social Network?
I do.
Which is about the beginnings of Facebook. And a lot of the business of that movie is showing how the early guys were screwed by the later guys.
That's right. Yeah. Is your question how to not be screwed?
Yes.
Well, yeah.
Yeah.
Like seems like VC is VC a minefield? Is it you need additional financial qualifications. You need a net worth of $1 million. You need all this. So it seems like VC is scary.
Yeah, I think, when you have, just take, we're talking about investing in startups, right? And I think it's like 95% of startups fail, right? So it is inherently risky and it is inherently scary. And all investing, at its core is essentially poker. You're making a bet, right? You're putting in some chips. You're hoping that you take out more chips than you put in. Lots of times you take out fewer chips than you put in. And so it is scary. I would say, as the industry has matured over time, there's an organization called the National Venture Capital Organization, which has, through a combination of different investors, different lawyers, different startup founders, different advocates, they've developed what are called the National Venture Capital Association, or NVCA, investment docs. And those are a standardized set of documents that in most cases, for an investment directly into a company, form the foundation for the negotiation that you can make the investment. So there's more guardrails. One of the guardrails that's in there is anti-dilution protection, which is exactly what you're referring to. It happened to Eduardo Saverin, where he did not have anti-dilution protection, or in bad faith, we don't know the exact terms of the settlement, but the other investors at the time diluted him without his knowledge. And ultimately, because of essentially the claims that for fraud that were made, I think it's generally well known that Eduardo still recovered a lot of the value that he would have otherwise would have recovered from those shares. And I think he's still listed as a founder on what is now Meta's website. So great question. In brief, it is scary. But over time, we have reached an equilibrium for at least the starting place for investing in these companies.
Just really quickly, and all along those lines, because I know the show is supposed to be a 30-minute show, similar to the medical show. Sometimes we go over 40 or 45 minutes on those shows and everything. But I'm just going to ask you really quickly, and I know this is going to be a regular show, so hopefully you'll be making a return. I know Solomon will be doing this regularly and everything along those lines. How important is it? Because we talked about how difficult it is in these monetary limits, but I know a number of people that were getting involved in venture capital projects because they were doing pitch competitions. So how important are those pitch competitions, and is that a good way to get your feet wet in venture capital because I knew a gentleman, I think it was an African-American gentleman, that had a battery charging product that he was putting out there and everything. And I think he actually got some capital, and I think he's doing well on that particular project because he was trying to find a way that if you're like off in the middle of Africa or off in other places that you can have your phone and other things that are sometimes having batteries that need charging charged and all along those lines. But he put out a company and it was pitched at one of our local pitch competitions. And like I said, I know he got some money, nowhere in that near that $1 million range, but enough to everything.
Sure. Salman, do you want to take that first?
Yeah. So I have I don't like Shark Tank, and the reason I don't like Shark Tank is that it is, you have these people that are trying to make decisions in like few minutes without any diligence. I like to really study the company. I want to study the financials. I want to learn about the market. I often would call an expert in that area and get their opinion and so on and so forth. So, the pitch competitions, in my opinion, are very dangerous because you can end up investing in a company or you could end up investing in a complete hoax. So ultimately, I mean, there's like no substitute for like knowledge and experience. Obviously, you can luck out as well, and you can invest in the next Google, for example. But it is total chance game when you go to a pitch competition. You don't even know. I like to invest in founders that I know personally, that I know have integrity, I know have quality experience, and so on. Sean, your thoughts?
Well, I mean, I guess it depends. Sort of my initial reaction, again, I can't comment, directly because it would be investment advice about whether that's good or not. But I guess what I'll say is this, is that, one, in terms of like access to venture, when we're talking about the accredited investor, limitation, that's when you're investing into someone else's startup, one in which you're not an insider. When you are, a CEO or a founder, you don't need any, explicit amount of net worth to be able to do that, because the idea is that you're a sophisticated investor. You're inside the company, that you're not going to be taken advantage or defrauded because you're inside it. And I'll say two things just for consideration for the audience. The first is that, given your timeline, right? Obviously, the earlier you're on life, the more risk you can take. As we mentioned many times throughout the show, risk is endemic in this industry. So when you're younger, it's probably a time that if that's something that you're attracted to, that you can take that risk. And I'll say second, too, is that I've had plenty of gold stars. I've worked at plenty of prestigious places, and there's plenty of fancy things on my resume. Part of what we're doing at Azimuth is it's a bet on myself. And, I'm not exactly an old guy yet. I have less gray hair, in my beard. But betting on yourself and just getting out there and doing it is something that I think can be truly rewarding. And there's really no other situation where I think you're going to learn more, because at the end of the day, you just got to figure it out. And so maybe less based on the potential economic returns, which can be fabulous, but more just for the experience and the fulfillment and purpose. I think it could be a good reason to get involved.
Yeah, that makes sense.
It's great educational opportunity, particularly if you go with somebody that knows a little bit about investing. Or even if you don't, I mean, just learning what is out there. I think Rick had like a great question: is how do I get involved in these things? You can learn what's going on. What does the future look like, and make your own decisions based on that.
Yeah, that makes sense. We're getting ready to get out of here with one of Nick's commercials about his pension company and everything. But we've got two Coloradoans on here, so I'll let them talk about Colorado really quick.
You Buffs, yes.
Yeah, go Buffs. Yeah, I hope Dion stays.
Me too.
So hopefully they have that Colorado similarities in common, and we'll get out of here with Nick's comments on his company, the pension fund. And I hope to see y'all back next week or in the very near future, because I know that this is going to be a regular show, and definitely I thought it was a good launch on this particular one. And like I said, I'll let Nick know that I thought both of you were great, giving great insights on that note, but an amazing job, and learned a lot on this particular show. So look forward to seeing y'all, and look forward to seeing you in person at some point, Salman, as well, since I'm just around the corner, not that far from Duke and everything. So look forward to seeing you in person again in the near future.
Thanks a lot for joining.
Take good care.
Yeah,
Stay safe.
Yeah.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252-1692.